While the S&P 500 barely moved this week, something profound happened beneath the surface that most traders completely missed. The Russell 2000 hit all-time highs, while the Nasdaq 100 fell, creating the widest performance gap between small caps and tech in months. This isn't random market noise. This is exploitable human behavior playing out in real time. I've spent years studying how psychological patterns create systematic opportunities in markets, and this week delivered a textbook example of why disciplined traders consistently outperform the emotional crowd. Let me show you exactly what happened and how the Stoic approach turns this chaos into clarity. The human layer reveals a market caught between two competing fears. First, concentration risk exhaustion. After years of AI-driven mega-cap dominance, participants are exhibiting classic recency bias fatigue. They're rotating out of technology into defense, small caps, and value stocks because loss aversion is driving them toward what feels safer. The crowd that missed prior rallies in neglected sectors now perceives them as asymmetric opportunities. Second, authority-driven volatility. Trump's defense budget announcement triggered immediate herding behavior into military contractors. Lockheed Martin and Northrop Grumman jumped 8% in a single day. But here's what's revealing about human nature. When the same authority figure threatened to block defense company buybacks just one day earlier, these stocks had plummeted. The crowd operates in pure reactivity, scanning for directional cues rather than building independent conviction. The technology sell-off exposes confirmation bias at work. NVIDIA, Broadcom, Oracle, and Micron all fell more than 3% on heavy volume. After months of debate about AI capital expenditure sustainability, any weakness validates the bearish thesis for skeptics, creating a self-reinforcing feedback loop. Meanwhile, Apple notched its 7th consecutive day of losses, not because of fundamental deterioration, but because sentiment has shifted. The system absorbed these psychological forces through distinct structural patterns. Index-level divergence became the dominant signal. Capital is reallocating within existing liquidity pools rather than creating net inflows. The S&P 500's ability to hold near records despite tech weakness demonstrates breadth expansion. Market leadership is distributing across sectors instead of concentrating in fewer names. Volume patterns confirm this interpretation. Value ETFs experience significantly higher trading activity relative to growth ETFs. This isn't speculation. This is institutional repositioning based on relative valuation opportunities. The bond market provided critical context. 10-year yields oscillated between 4.14 and 4.18%, unable to break decisively in either direction. When yields dipped on weak payroll data, equities failed to rally aggressively. The market no longer treats rate cut expectations as unambiguously bullish because participants recognize the Fed remains constrained by persistent inflation concerns. Commodities added another complexity layer. Oil rebounded 4% on Venezuela supply news, demonstrating how geopolitical catalysts override fundamental dynamics short-term. Gold and silver's continued strength near multi-decade highs signals ongoing demand for inflation hedges, contradicting the risk-on narrative implied by small-cap strength. This contradiction reveals participants hedging multiple scenarios simultaneously rather than committing to single macro views. The Stoic approach recognizes this as a market in transition between regimes, not crisis. Volatility is migrating from index level to sector level, creating opportunities for those who identify structural shifts rather than chase momentum. The rotation from growth to value represents natural rebalancing after extended concentration periods. This is the system seeking equilibrium. The defense sector's explosive move, followed by partial retracement, created a classic momentum spike and fade pattern. Early-stage rotations often produce false signals as participants test new themes without full commitment. The Stoic exploiter distinguishes between catalysts and narratives. The budget announcement provided a catalyst, but sustained defense spending growth will determine durability. Technology's weakness doesn't invalidate the AI thesis. It reflects valuation compression after expansion. NVIDIA declined, despite no fundamental deterioration in its business model. This is price discovery, not value destruction. The market is recalibrating expectations around AI monetization pace and economic benefit distribution. Process over prediction remains the guiding principle. The current environment rewards flexibility over conviction. The Stoic exploiter builds positions that benefit from volatility itself, maintains discipline around risk management, and recognizes that orderly rotation creates opportunities without systemic stress. The crowd reacts emotionally to every policy announcement and sector rotation. We remain disciplined, focusing on structural patterns that repeat because human nature never changes. If you value systematic thinking over market noise, subscribe for the psychological edge that separates consistent profits from emotional losses. Check the description for our complete framework on exploiting predictable human behavior in markets.